Imagine you're applying for a mortgage. A bank agent asks about your income, credit score, employment history. They show you a thick contract packed with numbers, terms, and legalese. You sign, commit to 30 years of monthly payments, and walk away with a house and several decades of debt. Now here's the twist. That specific way of borrowing, repaying, calculating interest, and assigning risk wasn't invented last year. It has roots going back over 2,000 years, to a time of togas, chariots, and emperors. This is a story about how ancient Roman debt practices are still embedded into modern finance, and how your mortgage today carries the fingerprints of Roman lawyers, philosophers, and creditors. Long before Rome, civilizations in Mesopotamia and Babylon used credit systems based on trust and kinship. Farmers borrowed seed grain and paid it back after harvest, with interest. But that interest wasn't calculated like today's compounding percentages. It was often fixed, predictable, and even forgiving during famines or floods. Debt was social, a bond between people, not a mathematical abstraction. By the time Rome rose to power, borrowing money was no longer just about relationships. It was about legal contracts, enforcement, and profit. And this is where things start to look eerily familiar. The Romans had a term, mutuum. It meant a loan for consumption, like borrowing money, food, or fuel, which had to be returned in kind. They also had a more specific instrument, the hypotheca. The hypotheca was the Roman version of a mortgage. Just like today, it involved a borrower pledging property as collateral. If the borrower defaulted, the lender could seize the property. Unlike in earlier cultures, this wasn't just an informal agreement. Roman mortgages were written down, enforceable in court, and structured with a sophisticated understanding of risk. They even developed a kind of early credit scoring. Reputation, past dealings, and social status all influenced how much you could borrow. Your mortgage today is a direct descendant of this Roman invention. The Romans also pioneered something even more fundamental, the idea of interest over time. Roman law allowed for usura, interest charged on loans, typically at an annual rate. This was the earliest form of what we'd now call simple interest, and it was tightly regulated. The legal interest cap was usually 12% annually, though lower rates were often negotiated among elites. Roman lenders were deeply aware of time's value, but unlike our modern compound interest formulas, they didn't multiply interest on top of interest, at least not legally. Yet informally, some lenders did use compound-like structures. Records show merchants reinvesting earnings and calculating returns in surprisingly modern ways, which means the math behind your mortgage payments today, with monthly compounding and amortization tables, has its roots in ancient Roman banking tables, clay tablets, and the basic logic of time and money. Now let's talk about what happened when things went wrong. In Rome, defaulting on a loan was no joke. At best, you'd lose your land. At worst, you could be enslaved. In fact, Rome's early legal system, the 12 Tables, included rules allowing creditors to physically seize and even sell defaulting debtors. Yes, the debtor, not the debt. This harshness sparked multiple revolts. Rome's famous conflict of the orders, which pitted the plebeians against the patricians, was partly about debt. Plebeians demanded relief from crushing loans and loss of liberty. Eventually, laws softened. Debt bondage was abolished, but Roman society kept treating default as a moral failing, a stigma that survives today in the form of credit scores and bankruptcy filings. Another aspect that survived is the linguo. Lien, principal, interest, clause, oblige, debitor, and mortgage are all Latin terms. Why? Because Roman law became the foundation of European legal systems, especially after the fall of Rome. When medieval scholars rediscovered Justinian's Corpus Juris Civilis, they used it to rebuild legal systems across the continent. Even English common law absorbed Roman legal ideas over time. So when your mortgage mentions things like security interest or right of redemption, know that these are the echoes of ancient Roman doctrines. The Romans created financial products that separated risk and ownership. One of these was the fideicomissum, a legal arrangement where assets could be held in trust, passed along, or managed for others. They also had a kind of early insurance pool, where groups of merchants shared risk by contributing to a common fund, especially for maritime trade. So while the Roman Forum didn't have traders shouting in suits, The concepts of managing future payments and distributing risk and ownership was already there. Fast forward 2,000 years, and mortgage lenders today slice your debt into tranches, sell it to investors, and spread the risk, all following that same ancient logic. The Romans were also obsessed with property. What it meant, how it could be owned, who had the right to use it. To them, ownership was a pillar of citizenship. In fact, for much of the Republic, only landowners could vote. Property wasn't just an asset, it was your voice in society. The idea that property is power influenced Enlightenment thinkers like John Locke, whose writings shaped modern capitalism. Locke believed property was a natural right. That idea fed directly into 18th and 19th century laws that encouraged home ownership, especially in the US, where land grants and later mortgage guarantees became a way to build a nation of owners. That deep link between debt, property, and citizenship comes straight out of Rome. You've probably heard the phrase, "all roads lead to Rome." Well, those roads weren't just for legions and merchants. They were for homeowners too. As Rome grew, the wealthy began building suburban villas outside the city. These country homes were debt-financed real estate ventures. Roman landowners borrowed money to buy, improve, and expand their properties, often pledging crops or rents as repayment. In a sense, this was the beginning of mortgaged suburbia, wealthy citizens using leverage to build homes away from crowded cities. Today's suburban developments, financed by long-term home loans, follow the same pattern. The Roman world also showed us what happens when credit systems spiral out of control. In 33 AD, the Roman Empire experienced one of the earliest recorded credit crises. A wave of defaults triggered panic among lenders. Liquidity dried up. Real estate values collapsed. Emperor Tiberius had to inject funds into the system, effectively a bailout, by distributing 100 million sesterces in low-interest loans. It worked, but it showed something crucial. Even ancient credit systems depended on trust, liquidity, and careful risk management. Sounds familiar? Just as the 2008 financial crisis began with a collapse in mortgage-backed securities, Rome's crisis shows how fragile debt systems can be and how governments inevitably intervene. So, when you sign that 30-year mortgage today, you're not just borrowing money. You're stepping into a system thousands of years in the making. The contract? Roman. The concept of collateral? Roman. And the stigma of default? Roman. Even the language in the fine print? Well, Latin, the Roman language. The association with Rome and money appears even in architecture. The New York Exchange facade evokes Rome. The U.S. Department of Treasury, which appears on the $10 bill, is also inspired in Roman designs. Your mortgage is a legacy of Rome, a reminder that our economy isn't new. It's a palimpsest, a rewriting over older scripts, older ideas, older civilizations. We no longer wear togas, or do we? But we still live in Rome, whether we know it or not.